So good morning, everybody. My name is Dave Hughes. I'm the Director of Product Management for Leverage. We are the Service Corp for the League of Southeastern Credit Unions. And today, I want to thank you in advance for joining us, spending a little bit of your time and learning more about CECL. And just so you know up front that this webinar will actually take roughly 30 minutes. It's not going to be the full hour, maybe 35 minutes. And so we'll give you back a half hour of your day. Hopefully that makes you feel good. So to get started, I'd like to introduce our presenter today. His name is Mr. Ted Ahn. He is the president of CRF Advisors, which is a credit risk management firm that services financial institutions, nonprofit organizations, and financial services companies. CRF Advisors focuses on assisting clients with the identification of potential credit issues through loan portfolio credit review, portfolio stress testing, and due diligence reviews. Ted has over 20 years in banking, including 9 years experience as an external and internal auditor, RSM, for financial institutions. Ted has managed financial institution credit risks and audit engagements, performed credit review of loan portfolios ranging from $40 million to $5 billion, reviewed and assisted clients in implementing ALLL methodology in compliance with the interagency ALLL policy statement and generally accepted accounting principles. And with all that, I turn over the floor to Ted. Take it away.
Okay, great, everyone. Good morning. I'm glad that everyone is able to attend our webinar here. I'd like to go over 3 topics here. One is just a brief overview of CECL. And second bullet point here is just to discuss the implementation process, whether it be various methodologies or the 2 methodologies that I want to discuss today, which is the third bullet point, which is the data requirements and examples of vintage and the WAR methods. There are other methodologies, just as an FYI. I'm sure that attendees on this particular webinar have heard of various methodologies, PDL, GD, maybe the scale, discounted cash flows. But the reason why I wanted to focus on the vintage and the WAR methods is because majority of our current credit union client base, we've used these 2 methodologies. In my mind, they're the most straightforward and the easiest to implement. And based off of the feedback from both auditors and examiners, it has definitely been an acceptable way of performing and calculating your CECL calculation. Okay. So just really a brief overview. I'm sure that many of you are aware of what the requirements are for CECL implementation, but if you don't, the credit union implementation date is 3/31/2023, or the full fiscal year or full fiscal period after your fiscal year end. So if you are a 6/30 year end, if you are a 9/30 year end, it would be implemented for the first period after fiscal year 12/31/2022. Okay. So what the whole purpose of CECL is, you're moving from an incur loss method to a lifetime horizon method. And so everyone, I'm sure, is using some type of quarterly annualized loss number and then adding maybe 1 or 2 qualitative factors to your calculation. The main difference is now, rather than just using that annualized loss ratio, you're now expanding that over the life of your portfolio. And the main aspect of looking at that is that rather than just taking a 1-year average, you're required to look at the lifetime horizon of each respective loan pool, i.e. your auto loans, i.e. your 1 to 4 family residential mortgages, and all that other pools in your portfolio. Okay, you're required to use a broader range of data to estimate expected losses, which requires you to accumulate collective or pool-based assessments and credit losses. So really what that means is that rather than maybe accumulating, one reserve for, all of your real estate loans, if you have home equities, if you have 1 to 4 families, if you have maybe in some cases commercial loans in that loan pool, you want to break them out from a risk assessment standpoint. Okay. It also applies to off-balance sheet credit exposures, i.e. loan commitments, standby letters of credits, and financial guarantees if you have that in your loan pools. Okay. Jump to the next slide here. So when we talk about CECL implementation and data mining gathering, what you want to do is you want to start by gathering various loan information from either the loan type or the pool type. So And that can, right, that can be allocations of auto loans. That can be, a breakout between autos of new and used. That can be, various consumer portfolios, credit card loans, obviously 1 to 4 family rising mortgages, home equities, and things like that. So that's what we mean by breaking it out by asset, by loan type, asset type, or pool. Okay. And the main information that you really need is gathering historical loss information, meaning that if we can go back and gather historical losses by year, by loan type, that's going to be very helpful as far as accumulating your initial historical loss data. All right. You want to ensure that key fields are extractable. So in the event that whether it's the WARM method, the vintage analysis, or any other methodology, you want to make sure that if you're reverting back to historical loss data, that they're extractable from your core system. And in many cases, upon our implementation, what we found is, some institutions, they've changed their cores, or they can't go back a certain amount of years just because of their system capabilities. But in most cases, a lot of our clients are able to go back at least 5 to 7 years in gathering historical loss data. So that's been very positive. Okay, so one of the things that you may want to start to do is ask your core provider, or try to go back and see how far back information you can obtain from your core system. And what that really means is that, can you get individual loan trial balances for maybe the past 5 to 7 years of your core, from your core system of your loan data, all right? And also keep in mind that I know that some pools may be serviced by third parties. So in the event that they are, you may want to ask a third parties, do they have some of that historical loss information or historical loan data to help in your calculation, all right? One of the other points here is that majority of your data is going to be purged. And what that means is that once a loan closes, there may be a timeline of 6 months, 12 months, 24 months, where your core automatically deletes that information. You want to find out what that frequency is, because that will help in determining how far back you can go with historical loss data. And really that pertains to what we refer to as the vintage methodology, because we want to be able to go back and gather loan origination data from a point in time. In our case, maybe 5 to 7 years. So gathering year-end loan trial balance information for the past 5 or 7 years is ideal. Okay, we have certain clients that can go back 20 years, which is great. But ideally, for the initial setup of your calculation, if you choose to use what's called a vintage analysis, you would want to try to get that historical loss information, historical loan data, as well as loss information from your core provider. Okay. There's various, the next point here is you also want to determine the contractual life of your portfolio. And what that really means is that, how do you determine what the life of your auto portfolio is? Whether it's new or used, how do you determine what the life of your credit card portfolio is? And there's different methodologies in determination of how you can accumulate that information. But more importantly, what we typically do for a lot of our clients is we will look at their closed loan history and say, all right, for the past 5 years, we're going to take all of your closed loan auto loans, or your home equity loans, or your 1 to 4 family mortgages, and gather all of your closed loan information. And from that information, we will then determine what has been the life of those loans that have closed. Because what that really means is that, or the output that you're really getting is that, based off of your own portfolios, you're getting that loss or that life experience for each respective loan pool. They can vary from institution to institution, but that's one of the easiest ways of going back and looking and say, all right, what is the life of the portfolio? And by doing that, again, looking at your closed loan information is it's probably one of the easiest approaches to take in gathering all the closed loans, maybe for the past 3 to 4 years in each respective loan pool, and taking an average of that. Okay, and so what our clients have done is that they've given us that loan data, and we've actually supplied them with that calculation based off of their loan information. Right. Bullet point number 2 here is to, again, consider expected loss methodologies. Again, we're going to go through the WARM methodology and the vintage. There are other methodologies like PDLGD, this kind of cash flows that we do have on our software that we help support with a lot of our clients. But our presentation, it's going to focus on the most basic methodologies, which is the vintage and the WARM. Again, the reason why is that both the vintage and the WARM require less data fields as well as less actual data. All right, so that's why as part of this presentation, I want to go through both those methodologies. All right. And this last bullet point, I shouldn't say number 3 here, is just to keep your board, your auditors, and examination team up to date. I think this year, your examiners are probably going to question, what have you done to start considering with the considerations of CECL? Have you started gathering loss data? Have you, started working with an actual methodology? And so some of those things are really going to probably come up in your 2022 audits or reviews, as well as maybe year-end 2021. Okay. Before I get into the actual methodologies of the vintage and warm methodologies, are there any questions that that I can answer based off of what we've gone through so far?
There is a question here, Ted, and I'll read it. At this time, do you know if very small credit unions will be exempt from using CECL?
Yeah, that's a question we get a lot, and unfortunately, the answer is at this time, I don't believe that they will be exempt. What the examiners have proposed are these simplified methodologies, i.e., the WAR method. That's why I wanted to address that today, as well as what's called the scale method. We don't prefer the scale method because you're taking peer information from large credit unions. So if you're deemed a small credit union, why would you take loss ratios from a larger credit union, especially if they have a more broader geographic exposure? But at this time, I'm not aware that any small finance institutions will be exempt from the CECL requirement, because it is a GAAP requirement. It's not a Fed requirement. So hence the reason why it's you're not going to be exempt from it at this time.
That's all we have for now, Ted. Continuing on.
Okay, great. And feel free as I'm going through the presentation to keep asking questions, because I think the more questions that are asked, I think the more all the attendees will get out of the presentation. So vintage loss rate approach, and this applies mainly also to both the vintage and the WAR methodology. So when we talk about loan data fields, and I think the most intimidating part of the initial implementation is, how far back and how much data do we need from our core provider or our current loan trial balance? As you can see, the data fields on the left here, account number, account name, loan type, the original loan balance, the current balance, the origination date, maturity date, renewal date, and close date. The close date is a date that the loan has closed. These are fairly simple or straightforward loan data fields. We have yet to come across an institution where they don't have, if not all, majority of these fields. I think the only tricky one might be the renewal date. And renewal date means that if we have a line of credit, if we have, a certain loan where it has a balloon payment, and we've extended that loan, and if that renewal date is not in our core system, we can easily figure out what that next modification date was. But that's what that pertains to, is that if you have a loan that keeps renewing, that means that without documentation or a field in your core system, and we just extend the maturity date, it seems like that loan has a long loan life. But in reality, it's probably shorter than that. And that's something that we've had to work with some of our clients to say, you know what, these particular loans have an origination date of 2010 and maturity date of 2022. Is this really a 12-year loan? And in most cases, it's not. It's just they didn't pick up that renewal date. Okay, and that's what that data field pertains to. But I think that for a lot of the credit unions, they're pretty straightforward, especially if you have a straightforward, auto portfolio, whether it's a home equity or a 1-4 family mortgage portfolio. You're not really going to have a lot of renewals. So if you have pools like that make up majority of your portfolio that are either in the auto, 1-4 family mortgages, HELOCs, that shouldn't really be a big concern for you for that data field. But otherwise, a lot of these other fields on the left, they should be straightforward, and hopefully that kind of gives everybody a little bit peace of mind as far as what data is needed from your core trial balance. Okay. On the right side is the charge-off data. So in the event that you've had charge-offs, the main information that we want to obtain is to obtain the account number, account name, again, the loan type, the original loan balance, what was charged off, the balance of the charge-off, the origination date, and the charge-off date. As you can see, a lot of these charge-off data fields, it mirrors what the actual data fields are on the left side here. So really, outside of, the charge-off balance, the charge-off date, or even the recovery date, that's really the only two fields that you need if you wanted to run what's called the vintage analysis, or it's also helpful in obtaining loss information to run a WARM methodology or WARM calculation. Okay. Any questions on just the data fields that I presented on this slide? Any concerns as far as their core system or the trial balance not having any of these fields?
I'm not seeing any, Ted.
Okay. And feel free to ask questions again as I move along the presentation. Okay. Okay. So this is just a screenshot of our software. The main focus of, or the main goal of going through this screen is that we want to communicate the reason why we want those historical trial balances and that data is that when you run a vintage analysis, what it's doing is that it's accumulating your historical loan origination dates by year. Here's a prime example. I know this balance is it's a high balance as far as total balance for this pool, but our goal is to obtain the origination totals by vintage year. And that's why we want to try to go as far back as 5 to 7 years to gather the information that was originated for that loan pool or even the total portfolio in some cases by year. Because what we're going to do is that it becomes a more granular calculation when you're able to do that because it's allocating losses by the year it was originated. Okay, so for example, in 2008 here, and again, this is the primary, this is an example. These loss rates are really high, but this is, this was done purposely for the example or for the purpose of the example. Okay, so what we're saying here is that they've originated 33 million in this respective loan pool in 2008, but they've charged off 11 million, 11.1. The purpose of doing that is because when you're allocating, the overall loss ratio, you're not allocating to the total pool. You're allocating it to, number one, that particular origination year of those loans that are still outstanding, plus you're using that loss ratio to help forecast your future losses. And that's the main goal of running a vintage analysis, is that you're trying to, depict what losses occurred by year, and then using that for those ratios to help forecast in those periods that have not occurred yet. Okay. In many cases, these are well below these particular ratios. They're usually in the single digits, if anything. Okay. So again, don't be intimidated by these numbers. This is here for pure example purposes. All right. So once you're able to accumulate that loan information, so what this represents is the opening amount. As of the date that we ran this, this is the active balance amount of 7.5 million of those loans that were originated in that particular vintage year. Again, total historical charge-offs, and then it calculates a loss percentage rate. Now, again, this loss percentage rate in the next slide here, it is spread out by various, vintage years. So, for example, in this particular loan pool, they've deemed this pool to have a 6-year life. Hence the reason why you see these 6 years here. Okay, and based off the outstanding balances, it's determining, okay, how many years are remaining in this respective vintage balances for each vintage year. Okay, so for example, in 2013, they're forecasting that there's 3 years remaining, as of today in that particular loan pool. Okay, for that vintage year. And they're using, for those periods and forecasts, what they're doing is they're actually using the average of their loss experience of what has occurred in that particular period for that respective loan life. Okay, so as you can see, typically in years 1 and year 2 and early on in your originations, you're not going to see that many charge-offs here. So that's the reason why these are zeros and your forecasts are minimal. But as a lot of times as the portfolio, it has a little bit more length to it. You're going to see a lot more charge-offs based off of the aging of the portfolio, right? Again, these ratios are very high. These are done for example purposes, but what it's showing here is that these ratios here as part of your forecast is taking the average of what historical loss experience has been in years 4, 5, and 6. Okay, and then also what you want to do, or the whole purpose of the vintage analysis, is that based off the remaining life here, say for example 2014, there's 4 years remaining, they're accumulating that 4-year period as part of the remaining life of the portfolio. Hence the reason why they're accumulating those losses to allocate to your active balance. Okay, I know there's a lot here. It's part of the presentation, but once you get through and obtain your historical loss data and loan data, it makes it a lot easier to understand. Okay, and what again our software does is that it automatically calculates what that projection is based off of your historical losses here. Okay, so many of you may be thinking, well, we don't have, we haven't had many historical losses. We've had minimal, loss exposures in certain loan pools. That's great. I think that for many of the credit unions where we see a lot of the losses or historical losses would be in your auto portfolio. In many cases, your highest loss percentage would be in your credit card portfolio if you have one, and some in your unsecured portfolio. If your portfolio is made up of majority of 1 to 4 family resident mortgages, you're not going to see a higher percentage there. So it's going to differ by pool. That's why we want to allocate it by a granular level of each respective pool, which many institutions are doing already. It's just we would then break it down, and making sure that we can gather that historical loss data for that respective loan pool. Okay. Okay, going into the next slide here. So this is really just kind of a walkthrough how loans are imported and how we're breaking out the various loan types by segment, i.e. consumer, residential, C&I, auto, etc. Okay. Your loan segments are sorted by origination year. If the loan trial balance has not been purged. Okay. So if the data has been purged, the goal is to obtain individual loan trial balances. So for example, 2007, 2008, 2009, and etc. Okay. And based off of this loan information, we will import that individual loan trial balance so that we can get the origination totals by loan type for that respective year. Okay. And luckily for us, it hasn't been a very tedious process. I think that, gathering that historical trial balance is really a step one, especially if you know that you have purged your historical loan trial balances. To try to go back and gather those individual loan trial balances starting from 2021 to 2019 to 2018, as far back as you can go, that's probably the first step to see, start gathering. When you talk about data gathering, that's probably the first step that you want to begin at. Okay. And as far as charge-offs, again, going back to as far back as you go regarding charge-off information, the great thing about a lot of our clients is that they already have a schedule of all their historical charge-offs, and they've been able to give us an Excel spreadsheet to say, all right, you know what, here's the support for all the auto loan charge-offs, here's support for all of our 104 family mortgages, any consumer charge-offs. They've allocated separate schedules for that, and so hopefully that doesn't take too much information, which means that you have minimal charge-offs. But again, that information hasn't been an issue regarding a lot of our clients. Okay. So I've gone through the vintage analysis fairly quickly here. Are there any questions, and are there any, and this can even pertain to other methodologies and things like that regarding historical trial balance and historical loan data?
I have a question here, Ted, that has just come in. What is the minimum time frame a credit union should look at historical data?
Yeah, I would try to get between 5 and 7. Ideally, if you can go back 10 years so that you can get a full cycle, that would be ideal, especially if you wanted to use a vintage analysis. But that's typically what we've seen with a lot of our credit unions is between 5 and 7 years as far as trying to get historical loan trial balance information from their core system.
No more questions so far.
Okay. And again, please feel free to ask questions as we go along. Okay. So I'm going to jump into the warm approach. This has been probably the most popular approach with a lot of our credit unions that are 200 million and under. A lot of our current client base that's around 300 million above, they've used a vintage analysis because they've been able to gather their historical loan information as well as the loss information. And I would highly recommend that if you're a fairly sizable credit union that you try to go the vintage route or some type of software calculation. And that's just because it's a lot easier when you're gathering your quarterly information for your call reports. Okay. But if that's not the case, a majority of our credit unions have fallen under the 200 million in portfolio size. So what we've done is that we've accumulated what's called a WAR methodology. And the WAR methodology acronym is the weighted average remaining maturity approach. Okay. Which means that it's determining what the average remaining maturity is of each loan pool and applying your annualized loss rate. Okay, so as you can see on this template, it starts off with your 10-year annualized average loss ratio. So we have a template that identifies, what the annualized loss ratios have been for the past 10 years. Okay, and the good thing is that again, this can easily be taken off a call report, off your historical loan data. That's why I say it's important to get your charge-off information together, because it helps in identifying what the annualized loss rates have been for the past 10 years for each respective loan pool. All right. So here in this example, there's personal loans, there's credit card loans, there's student loans, commercial loans, and so forth. Okay. And really, once you're able to obtain that annualized loss ratio, what you're doing is you're multiplying it by your weighted average life. Okay. And what that means is that, for example, if you're, in this particular example here, if your closed-end mortgages have a life of say 7 to 8 years, when you calculated the weighted average life, and there's a separate formula for that to determine what that weighted average life is. Say, for example, it comes out to 5 years. All right. So you're not applying that multiple of that average annualized ratio to the term of the loan. It's calculating a weighted average life of that particular loan. Okay. So when you do that, you're then multiplying that annualized ratio times what your weighted average life is to come up with your life loss rate. Okay. So it's fairly straightforward as far as the math of it and from a template standpoint, but the harder, or where it takes a little bit more work is determining what that weighted average life is. Okay. And really it's taking your term of the portfolio and incorporating a pay down rate, or in essence, a prepayment rate, to determine what that weighted average life is. But the template that we use, it's very straightforward. There's not really a prepayment consideration. It's just what is the average interest rate on portfolio, and if it has, a 10-year term, what would that weighted average look like if it were to pay down at a certain rate? Okay, and so again, it's all Excel based. It's a very straightforward calculation, and once you come up with your life loss rate, you would then apply several qualitative factors to your portfolio. Okay, I know a lot of our credit unions, they have applied maybe one factor, maybe for economics, or one for past dues non-accruals, or maybe they blended one particular qualitative factor, maybe 20 basis points to the whole portfolio, maybe even higher, as one qualitative factor. But you really want to granularize that particular assessment. In this particular example, they've broken out the qualitative factors between economic conditions, concentrations, collateral, past dues, and environment conditions. Okay. But again, there is no requirement that you have to use more than one. But I think that based off of looking at some of the risks in the various portfolios, it may be prudent to kind of expand that a little bit. Okay. And then as you can see is that once you apply that life loss rate, and once you calculate that life loss rate and apply the various qualitative factors, you accumulate an aggregate loss factor, right? And then you're applying that ratio to your loan portfolio. Okay. So this is a very straightforward calculation. This was actually provided via the interagency guidance via all of the various regulatory agencies, whether it was the Fed, the FDIC, the NCUA. So our template, or this particular template, has really come straight forward from their example. And it's, again, in our mind, it's the simplest, straightforward way of calculating a calculation without having to use any type of software or having to gather a lot of historical loan data. And all positive of using the WAR methodology is that you're using, as far as loan data, you don't have to go back and gather historical loan data. You can just use the current balances. But what's going to be important is that in determining what this annualized, the past 10 years or the past 5 or 7 years as far as the loss rates, that's where a lot of the heavy lifting is going to occur. Okay, and again, many institutions, it's been fairly straightforward in obtaining that information. They're just going back to the call reports, or they already have the loss information or percentages for the past 7 to 10 years or 5 years. And you can, again, annualize that information and then apply that to your weighted average life. Okay. So again, this has been the most widely used and straightforward calculation. And, based off of our current clients that have used this, or we've helped them when preparing this calculation, their examiners, or at least their auditors, have been okay with the overall calculation. And hopefully, looking at this looks somewhat familiar as far as overall template and what everyone's using today. So really, it would be just an expansion of what everyone is using from an annualized loss ratio here. Okay. And then adding the qualitative factor. And the main difference being applying this weighted average life, because again, you're applying that loss rate over the life of your portfolio rather than just an annualized rate, which is the current incurred methodology that everyone's using today. Okay.
We have a question here, Ted. Actually, a couple of questions. You mentioned templates for those two types of methods. Where are these available?
So from the WAR method, they're available. There is an interagency guidance that came out probably in 2019, and that template is actually available via. If you go back to their interagency policy, the template is part of their guidance from the WAR methodology. For the vintage, it's a methodology that's also been circulated from the various interagency guidances, and I think that might have came out back in 2017. So the actual templates of the guidance that's provided by your regulators, it is out there. And we've developed obviously our own software to incorporate those various templates so that it's part of the support for our software and our calculation. But this is available via the interagency guidances. So if you look up NCUA interagency guidance, CECL guidance, this and look up WAR methodology, this template should pop up. If you look at vintage, and you look at way back in probably 17 or 18, they actually came out with guidance on the vintage analysis. A lot of our credit unions, unless they're, again, sizable, they've reverted to either the vintage or the PD-LGD methodology. Again, we prefer the vintage because it's taking your actual loan data, but that methodology is also out there. If you look at various CECL methodologies back in 2000, I think interagency CECL methodologies, the vintage example will pop up as well.
And we have another question here. If the longest term loan we have is 6 years, for example, an auto loan, is it okay to just go back 6 years to determine the 6-year cumulative loss?
Yeah, when you go back, so when you're looking at historical losses, you're not going back over just the most immediate term. Again, you want to kind of have a life cycle. So a lot of our clients, they've taken charge-offs from 2010 all the way through 2021 in their analysis. That's because they're picking up the Great Recession, right? They're picking up some of the losses that were occurred during that period, and they're averaging out those losses, because the reality is that in certain pools, your auto loan portfolio is going to incur losses every year. But in certain pools, like your 1-4 family or your home equities, over the past 5 to 6 years, you probably have not incurred any significant losses, or maybe back in 2010, 11, 12, you may have incurred some losses there. That's why you want to try to pick up a further expansion of a period. But again, we have other clients that said, you know what, we're going to use 5 years, we're going to use 7 years. So that's actually preferential to every institution. It's what you believe is reflective of the next cycle of loans for that respective loan pool. So there's no right answer to that particular question, but ideally you want to try to get as far back, you want to try to go back as far back to obtain that annualized ratio.
We have one more question here, Ted. How are participation loans treated in the CECL calculation?
Yeah, so that's a good question. Participation loans, it's whatever your exposure is, that exposure is, you have to apply a CECL calculation to it. I think the tougher part in some cases is that depending on if it's a purchase pool or if it's just a participation, a fraction participation in a respective loan pool or an actual individual loan, you need to be able to make that determination. A lot of our credit unions, they purchase auto loan pools, they'll purchase student loan pools. That loss information, you'd still have to determine what that average remaining life is for that respective loan pool, and then apply an applicable loss rate to that respective exposure, whatever our portion of the participation is. Okay. Hopefully that answers that question, but really whatever our exposure is via the participation, that CECL will apply to that overall exposure. And to calculate and determine how to calculate the remaining life, hopefully by the respective loan type pool. So to say for example, it's a participation in a resi pool portfolio, that resi pool weighted average life determination will be the same, and you just apply that same weighted average life to that respective exposure that we have for that purchase participation portfolio.
Okay, we don't have any more questions at this point.
Okay. Hopefully everyone has somewhat been familiarized or has heard about the warm approach. Again, it is available. And actually I don't have the exact link, but if you look up the warm methodology and interagency guidance, the example will pop up there. Okay. And all we're doing is we're taking that example and we're applying it to a template where our credit unions can apply it to their or utilize it for their calculation. Okay. These next couple of slides here, they're more so from a qualitative factor standpoint. What we do is we try to provide a lot of third-party data to our clients. And this is something that hopefully as you incorporate and you work on your qualitative factors, that you'll also be able to start taking a look at some of the historical trends. So here, for example, what's blue is GDP. GDP is really not going to have an impact on your, may not have a direct impact in your portfolios. It may, depending on, all the loans and your exposure to of how big that is in your portfolio, that may have an impact on your overall risk. But really, unemployment rate and the general default rate is really what you want to keep track of. So for example, in this particular case, you can see a direct correlation between defaults and unemployment. And so when you start incorporating, here's one where there's an inverse relationship in interest rates, right? So when you're looking at historical loan data and historical performance, that's what you want to actually use as part of your your basis for determining of some of your economic conditions and your qualitative factors. Okay, so as you can see here, this is back 2008. There's a direct inverse relationship between unemployment and default rates to the interest rates here. Okay, so as interest rates have climbed, or if you know that there's a certain unemployment rate in your local area, what you can do is start incorporating and putting some of your actual loss data in there. Okay, so your loss data or your delinquency information. So that way you can go back and revert to say, you know what, when unemployment was at 6%, or when rates were at, when prime was at 1%, where was our potential default in our in our loan pool, and use that information as your starting point. Okay, which is been very helpful when you're looking at historical loss data, so looking at historical loan information, as well as even some of your peer information, looking at some of that information to help support where has their performance been and where has our performance been, and looking at some of the historical performance to help support some of your qualitative factors allocations. Okay, as due to COVID in 2020, we saw a lot of our clients increase their economic conditions based off the uncertainty of potential defaults, whether it be auto loans, whether it be residential loans. Obviously, majority of our clients have not seen the level of concern as far as defaults in those respective loan pools for our credit unions. But I think that for looking 2 to 3 years ahead, that may still pose some risk in your portfolio. We know that in 2020 and 2021, there are a lot of incentives, there are a lot of state or government assistance as far as mortgage deferments, obviously the various payments that went out to help keep the economy afloat. But obviously that has been turned off, and I think going into the next 2022 to 2023, it'll be the real telltale sign of how our economy performs, and that's something that you may want to consider when you're determining your qualitative factor allocations for your calculation. Okay, and there's other determinations and methodologies to determine what that would look like, but I think this is the most easiest, is looking at historical performance of where your credit union has performed versus rates, unemployment in your geographical area, and overall defaults of your peers. I think that's probably one of the easiest things to take a look at from a historical standpoint to help support some of your qualitative factors, and even in some cases your calculation as well. Okay. As far as implementation as far as those participants on this call, have many of you started implementation or started gathering your loan data?
You can answer that question in the chat box if anybody would like to.
Any responses there, Dave?
Not seeing anything.
Not seeing anything. Okay. Okay. Are there any questions? I mean, that's what I want. Those are the two main methodologies that I wanted to go over today.
Here we go. We have a comment here. Qualitative factors seem vague. If you are using forecast unemployment and say forecast unemployment is 3%, how do you know what to put in the methodology?
So if unemployment is at a certain point and you see peers and you see general default rates regarding financial institutions nationwide, what some of our clients have done is that they've said, you know what, at a 3% unemployment rate, where have they been as far as delinquencies and non-accruals? And then looked at what they've currently allocated for a loss rate in that respective pool to see if they needed to increase or decrease the reserve levels for that respective pool. And I think that the toughest part for the qualitative factors is that it is very arbitrary, but the expectation is that there should be some type of consideration regarding economic conditions, any type of financial performance within your calculation for potential future losses. Because there's two sections, or there's two parts of your CECL calculation. It's your initial forecast based off of your historical performance, as well as your expected, expected loss ratio over expected performance. And no one has a crystal ball, so no one can really predict that. But an allocation to incorporate some of that potential risk is going to be, it's best practice as part of your CECL calculation. And in order to do that, one of the best things is to try to look at historical performance to help support your calculation.
Okay, I don't see any more questions at this point.
I hope this has been helpful. Again, implementing a CECL calculation, should be very straightforward. It does not have to be complicated. When we work with our credit unions, we try to make sure that it's a very simplified process. I know that there's been a lot of back and forth as far as gathering years and years worth of loan information, but we try to keep that level of historical data. If we choose to use, for example, a vintage analysis, very straightforward. And we've had very good experience in assisting our clients with that. But more so, and there's more methodology. The good thing about this methodology, again, is that number one, you don't have to gather a lot of historical loan data itself. It's just historical loss information that's going to be something that we have to pay more attention to and try to gather. And then just applying the overall ratios to your portfolio is fairly straightforward. And again, qualitative factors is going to be very arbitrary as far as what allocations there are, but it will be expected as far as providing that potential future loss assessment over the remaining life of your portfolio. And that's where that emphasis of qualitative factors comes into play in your calculation.
Okay, I'm not seeing any more questions. And Ted, are you? If I can wrap this up right now. If you are ready to do so.
Yes, if it's no more questions, and please feel free to continue to reach out to either Dave or the Leverage team if you have any additional questions, and we'll be more than happy to.
Oh, we have some more questions here, Ted.
Oh, good.
A couple more. How often are we required to check our expected loss? Once per year, quarterly?
Yeah, this should be done on a quarterly basis because you're reporting your reserves on your quarterly call report. So the expectation is that every, a lot of institutions, they do it monthly. A lot of them do it quarterly. So, but at a minimum, it should be done quarterly because that will affect your quarterly reporting for your reserves.
Okay, and another question here. Are you stating WARM will prepare us for CECL in 2023?
Yes, this is one of the preferred methodologies that we've been assisting our clients with for CECL, for their CECL calculation. Yeah. So regarding the templates that we've been assisting our clients for, that is what they're using to support their calculation.
Any more questions? Okay, well, I'd like to thank everybody for taking a bit of your valuable time out this morning to join us. Just so you know that I put my email address in the chat box. You can write that down in case a question pops in your head later on. I can take that and forward it on to Ted, which I'd like to thank Ted for his valuable information. A lot of good stuff here today and a lot of good questions asked. So I appreciate everybody joining in. So given all that, if there aren't any more questions, we'll call it a morning. All right then. Thank you. Thank you very much. Thanks, Ted.
Great. Thank you, everyone. Good seeing you.
Bye-bye.